You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell securities or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out www.optionseducation.org. Now, here's your host, OIC's Director of Retail Education, Ed Modla. It's time to break down the latest option strategies. That means it's time for Strategy Spotlight.
Joining me on Strategy Spotlight today is Luke Rahbari, who's the CEO of Equity Armour Investments based out of Chicago. Very fortunate to have Luke here with us. Thank you for taking the time out of your busy schedule to join us, Luke. Why don't we start with a little bit about your background in the industry, how you got started, how things have evolved, and what kind of things you're up to today with Equity Armour.
Yeah, thanks for having me, Ed. I started it in the business actually when I was in college. I worked for my dad's broker, and back then he was selling a CTA from a manager that was well known in Europe but not here, called George Soros. So I won't tell you how many years back that is, but quite a few. So I've always been interested in the markets. I got an opportunity to come and start on the CBOE floor. I think it was around 1992, and I worked for Letco, which was a big specialist, options trading specialist unit there, and I went on to work for a bank and run an equity derivatives desk there, and then I was a chief investment officer at another firm, and right now with Equity Armour, we're creating products for distribution. We're a manager for a mutual fund. We're running portfolios and trading volatility and options.
Well, that's great, Luke. That's a storied history and background with certainly some big names mixed in. So, again, really appreciate your time today as we focus on options strategies. I know you wanted to talk about income strategies that enhance a stock position, Before we get there, one of the sometimes overlooked pieces of the puzzle is an initial outlook or a market opinion. Can you tell us a little bit about how you develop a market philosophy or come to an opinion on market condition that could lead you to open a long position in a particular stock?
Yeah, so I mean, it's a great question because that's where every investment idea starts, right? You've got to come up with an idea. You've got to decide what you want to do, what it is you want to do, and then we use options to try to enhance that idea. So most of the stock ideas that we come up with, obviously, we're in the markets every day, do a lot of reading, but we also have a quantitative firm that is our partner, and they use a multi-factor stock ranking system mixed in with some forensic accounting and also global economic indicators. So we get a list of stocks. That quantitative method produces a list of stocks that we get. From there, we take a look at the stocks and then say, all right, given what's going on in the market and what we know about these stocks and what's going on, what are some of the stocks that we believe still have some upward momentum? They're going to have some growth. How do those stocks look depending on what the global economy is going to do? Because obviously I don't have to tell you global factors are really moving the markets these days with the tariffs and oil and interest rates. So we kind of narrow that down, and then we come up with a list of stocks that we think are going to do better than some of the other stocks in that same industry or the overall stock market. And then we establish a long position by buying those stocks.
I see. Well, that's certainly a thorough vetting system. It sounds like you have a very well-established multi-tiered approach to that. Now that you have the market opinion and you've selected some stocks, and of course we have to translate that into a trade. So let's say you have the bullish outlook in place for staying on the long side of the market for this discussion. What is the initial position that you most prefer to open?
Right. So, going back a little bit to the previous questions about income generation as well, with the current market conditions, what we like to do is we like to be long stocks. So we buy a stock and then we sell an out-of-the-money call on it. And this does a couple of things. Number one, if you're going to trade stocks or options or anything else, commodities, you have to be disciplined. And it's difficult for the average investor, myself, whomever, to stay disciplined with all the news coming at you and all the ups and downs from minute to minute. What selling an out-of-the-money call does is it helps you stay disciplined, because I just described what we do to get into a long stock position. But when you get out, what is your price target? How long do you want to hold it for? If it gets to a certain price, do you want to sell out of it then? And if it does get there, do you have the discipline to say, hey, I made the money I wanted to make in the time period I wanted to make. I should be out of the stock now, right? So what selling the call does is we buy the stock, we immediately sell the call, and then that gives us discipline to say, let's say, for example, we buy stock at $100, and then we sell a out-of-the-money call, the 110 strike, 2 months out. If within those 2 months the stock goes to 110 or higher, we're probably going to get exercise in the call, but that's what we wanted anyway. That's what we thought our profit potential should be in that time period. And I didn't have to listen to a lot of news or get kind of thrown off by my game by a lot of noise. I stayed disciplined. I bought the stock. I said, if it gets to this point, I want to be out of it. I sell the call. If it goes through 110, I've sold the stock and I've made that money. If it doesn't, what it does for me is I bought the stock at 100 and I brought in some premium, let's say $10 for selling that 110 call. It lowers my money at risk. It lowers my break-even point. And it generates some income for me while I'm waiting for that stock to go higher, as I think it should.
That's a lot of useful insight. You said a very key word there, discipline. It's very difficult oftentimes for investors to know when to get in, when to get out of trades, and what prices to use. And you're exactly right. options can help force that discipline on you, whether you're long or short, various strategies. They give you your entry and exit points, so options can be very useful in that regard. You mentioned when you were walking through some numbers of strike prices and stock prices. It brings up a question that I get very frequently regarding selecting those levels. Do you have a preferred approach when it comes to selecting strike prices and expiration dates and how you determine the details of the trade?
Yeah, absolutely. So just as you make a decision of what stock you want to buy, selling or buying an option is the same decision. And again, just for the covered call position that we were talking about, you can use that simple example and say 110 strike, 10% higher within this period of time. But we go a little deeper before we sell a call. So some of the things that we always look for in a stock are the following, which we actually have outlined in a book we've just written on options trading. But these are the important things that you need to know. First of all, you need to know if the stock pays a dividend. Okay? You don't want to be out of that stock. If the dividend is being paid in the next couple of weeks, you want to be the owner of that stock, or in the next month, you want to be the owner of record of that stock to be able to collect that dividend, right? You want to know when the earnings date on that stock is. Is there a big earnings event coming up in the stock where maybe you shouldn't even be in the stock, or if you think you're positive, you want to pick a different strike, or maybe you don't want to sell a call, maybe you want to buy and put to be more hedged. But it's important to know if the stock pays a dividend. It's important to know if the stock has got earnings coming up, because there's going to be a big move in that stock. It's important to know what ETFs this stock is in, and if it's included in these big ETFs. And you want to know some of the other companies that are involved in the same business as the company that you're invested in. You want to know what their earnings dates are. Those are some of the things we use also with our price targets of how far we think the stock can go before it becomes overvalued, or if it changes our fundamental outlook on that stock. So if the stock is a good buy at 100, and maybe the PE ratio is starting to push it at 110, I'll sell the 110 strike. I make sure that I'm going to collect any dividend if the stock pays a dividend. And if there's earnings event coming up, I'm probably going to try to move around it a little bit. But if there isn't, then I'm pretty solid on my decision. Over this period of time, without any earnings coming up and being covered on the dividend, if the stock moves this much, I want to be out of it. That's how we make our decision.
Yeah, that's a lot of good material, really outlines the trade nicely. And I want to continue along this path, mostly in sequential order. We had our outlook and analysis. We decided on the type of trade we wanted to put on, and now we have it established. So let's say we have this trade, stock XYZ, and now we have this position on. The next piece is monitoring an active trade and deciding if we need to make any tweaks or adjustments to it. How does that work for you as far as monitoring the trade? What signals are you looking for that might break down your thesis or change your perspective?
Another great question, right? This isn't exactly set it and forget it, like chicken in that oven, right? You've got to keep up with the position. You've got to keep up with the stock. So some of the things we do, which is also easy, it's not so hard for the average investor to do it on some of the retail platforms. We set up a news alert on the stock. So anytime any news goes across the stock, we get an audio alert. We set up price alerts for the stock. If the stock moves a certain percentage or a certain dollar amount during the day, or if it hits some sort of level, we have alerts set up, and we also do the same for options, right? So if there's something going on in the stock, or if there's something going on in the options, we want to know about it. And obviously, not to simplify too much, but there's three things that can happen to the stock and the option once you put the trade on. It can go up, it can go down, or it can just go to zero, right? So going back to the example of the $100 stock, we buy stock for $100, let's say. We sell the 110 strike, which means if the stock trades at 110 or higher, we would be taken out of our stock. We've sold our stock. And let's say we sell that for, I think the example I used previously was $10. Okay? So now I say to myself, I've got a 10% upside on the stock, but if the stock goes down $5 from 100 to 95, I want to be out of this trade. Now, if you add up the dollar amounts here, and I hope I'm not going too fast, but I bought the stock at 100. I received $10 for selling the 110 strike. My new break-even point for the entry in the stock is now $90, meaning if the stock goes down to 90, I still haven't basically lost any money, and anything below 90 is where I start to lose money. So now I've built myself a little bit of a cushion. And since I bought the stock at 100 and I sold the 110 strike for $10, the equivalent price for me is the strike price of 110 plus the $10 premium I received. So I'm really selling the stock at an equivalent of 120. So I'm looking for a 20% upside in the stock. And if the stock goes down to 95, which is what I've set for myself, $5, I want to get out of the stock and still have $5 left over out of that $10 premium I collected. And I hope people can go back and listen to this a couple of times. I went a little fast, but it's really important because I'm letting my profits run and I'm limiting my downside. Okay? I collect that $10 to sell that call, and I'm willing only to take a $5 loss in the stock before I have to sell the stock, obviously buy the call back. But there's been numerous studies done over the years about how average people tend to trade stocks or tend to trade assets, and over 90% of the time, the average person lets the losses go on for much longer than they let profits go on for. So as soon as they have a little profit, they try to get out of it, and then if they have a loss, they hope that it comes back or they double down, and they don't get out of it soon enough. Having the strategy makes you stay disciplined, okay? Hopefully the stock runs up really high and I get taken out of it, and the discipline has already been in place for me. But before you go in, have these numbers in your head. How much pain can you take? How much profit are you looking for? And when they hit those levels, you kind of automatically have some of those set up, execute through them, and let your profits run, limit your downside.
Yeah, you mentioned that word again, discipline. Couldn't agree more, and it sounds like your approach is very concrete and crystal clear when to get out on the downside as well to keep your risk-reward profile appropriate. So let's finish with this. Assuming that the trade you have on the covered call has gone to expiration, there's a couple of different ways this can go. As you said, either you're assigned and you're out of the trade, or you're not assigned and you still have a long stock position, assuming you haven't closed the whole thing out. So there's a couple different possibilities that we'll end up with at expiration date. Can you take us to that next step? That'll finish off the whole cycle here. When we've reached that point, what comes next? Is it reestablishing another covered call position? Are you going back to step one and doing your market analysis all over again? What types of things are you doing, whether you're assigned or whether you're not assigned?
Yeah, so again, great question, and the reason it's a great question too is it closes the loop on this trading idea. So, as you said, let's be optimistic for a second and say I sold the 110 call and the stock just goes through. It's trading at 120, right? So I've made my $20. So now, and this has happened, let's say at expiration or before expiration. Now I've got to sit back again and reassess the stock. Maybe there's been news, maybe something has happened that has made me change my mind about the price target for the stock. If I think the stock has still got legs and it's going to continue to go up, I could reestablish the position again, buy the stock at 120 and sell another out of money call. Or one of the strategies we use for customers is we'll now sell, and this is on the different side, we'll sell the 120 put. Okay? So remember, I bought the stock at 100. I basically got out at 120, and now I think 120 might be another good re-entry point for me, but maybe I'm not sure. So I'll sell that put, collecting maybe $5, right? Meaning that if the stock comes lower, I basically bought the stock for about 115, right? 120 minus the $5 premium I bought. That's my new break even on the stock. And if the stock goes higher, maybe I never get exercised on the put, but I collected the $5. And now that's just adding to my profits. And maybe a month from now, the stock is still at 120. I still think it's a good entry point, and I sell another put, right? So again, creating income off a position. I don't have a stock position this time. I'm just doing it with a put. And I'm saying to myself, I'm willing to get back into the stock at 115. And if it never gets there, I'll just continue to collect a premium on that put until it does, or I change my mind about the stock. On the pessimistic side, let's say the stock goes down. As I said, we would probably take it off right around 95, try to keep that ratio around the same thing. But also, maybe my idea about the stock hasn't changed that much, and maybe the stock just hasn't moved that much, but my option has moved. So let's say I bought the stock at 100, I sold the 110 strike, as we previously said, and it's 3 or 4 weeks into the trade, and now the stock is still at 100, but that option has come down a lot. And we have certain rules that we trade by. Any option, basically, that gets below $1, we look to close. Because from that point, the decay on the option is going to be so little that there's no reason to have that risk out there of the stock running up. So we'll buy the option back at a lower premium that we sold it for. We said we would sell it at $10. Maybe we buy it back at $2. Maybe we buy it back at $1. And then look for another option to sell, look for another strike to sell, and continue to collect that premium and wait for the stock to make that upside move. So even if I wasn't completely right on my analysis and the stock didn't go down and it didn't go up, I still created income. And I still gave myself a downside cushion, and I gave myself a much better risk-reward ratio of having the stock go up versus how much I was willing to take on a loss.
That's really well described, Luke. Thanks for that. It's premium on both sides and excellent analytics along the way for what you're looking for in the market. It sounds like this approach would require a lot of attention, but that's part of the fun, too, is staying on top of the markets, entering, exiting positions, and all the necessary position management. All good stuff, and thank you for that description. Luke, do you have any final thoughts for our listeners, comments about this strategy or options in general that you'd like to share to wrap up?
Well, I think, there's a few things. You guys are a great source of education for options. You don't have to get in and dive into options as a pro does. You guys can get a lot of information from the OIC and other sources, kind of read up, listen to these podcasts, et cetera, and kind of get your feet wet. That's the first thing. Secondly, if you're going to get into stocks, I almost think it's better to trade a covered call rather than be naked to stock. If you're just getting into investing, learn about options. They're a great tool. They can definitely help you. They can help you stay disciplined. So I think to continue to learn and continue to keep up on the markets is the best thing you can do to try to be successful when investing.
I certainly would echo that statement about utilizing the OIC's education and using options around stock transactions for sure. Very good. Lots of good material. Thanks for joining us again, Luke, on Strategy Spotlight.
Thank you for having me.
Ready for a little nostalgia? It's time to take a look back.
Occasionally, during our Looking Back segment, I'll deviate a little bit away from the option space and even a little bit away from the market itself. Today, I want to talk about a period of time that's known as the Great Inflation, which was a macroeconomic event that lasted almost 2 decades from the mid-1960s to early 1980s. Let's first go back to Economics 101 and define inflation as the rate at which the price of goods and services increases over a period of time. This, of course, is directly tied to the value of a currency and the purchasing power of individuals. In the early part of the 1960s, and for some years before then, the inflation rate was holding steady at just over 1%. Then a few changes in policy, perspective, and priorities went into effect, and it greatly changed things in a negative way. After World War II, which followed the Great Depression, which of course had massive unemployment, Congress actually mandated the federal government to prioritize achieving and maintaining full employment. Some of you may be familiar with the Phillips curve. If you're not, you can look that up. It's an economic indicator which simply outlines the inverse relationship between unemployment and the inflation rate. In other words, as inflation rises, generally speaking, unemployment is coming down. Policymakers decided to accept inflation and even encourage it as a trade-off to accomplish this mandate of obtaining full employment. For example, amongst other things, this means the supply of money dramatically increased. What policymakers didn't recognize at the time and what we now know is the Phillips curve relationship is only valid on a short-term basis, but over the long term, it will completely break down. Unfortunately, for those who lived through this time period throughout the 70s, this breakdown resulted in both higher unemployment and higher inflation, which is a devastating combination. During the period, the unemployment rate topped out at approximately 11%, which is very high. Inflation was even higher. The peak rate of inflation was over 14% in 1980. Put that in perspective, over the most recent 10-year period from 2009 to 2019, the range of inflation has been 0.7 to 3.0%. You can imagine how scary that must have been in 1980 to see that rate over 14%. Some of you may think of the inflation rate as the amount of money you need to earn more from one year to the next, or the amount of increase you need to see in your compensation from one year to the next just to maintain the same buying power. Imagine if that rate was over 14%. When we got into the 80s, new leadership at the Fed took over and reflected on these mistakes and effectively reversed the priorities, focusing on exactly the opposite than was previously in place in the 1960s. In other words, policies were implemented to bring inflation down while accepting short-term spikes in unemployment. This tactic worked quickly, and within a few years, both inflation and unemployment had settled down. Inflation steadily decreased. Unemployment had quite a bit of movement and fluctuation up and down, but that was tolerated, and inflation eventually settled around 3.5% for most of the rest of the decade, and it's been under control for the most part ever since. It's a fascinating story, and there's a great article online if you're interested in reading more about this situation. An article called The Great Inflation can be found online at the Federal Reserve History website, www.federalreservehistory.org. And that's today's Looking Back.
Next, let's upgrade your options toolbox with cutting-edge trading platforms, devices, and information. Let's talk about tools, resources, and good reads.
On occasion, a source of confusion for options investors can be the treatment of options after a corporate action, such as a stock split or a spin-off, merger, bankruptcy, and a host of other possible corporate actions. There's a tool on the OCC's website which provides details and insight into what happens to option contracts in these circumstances. It's the OCC Information Memos tool located on the OCC website. That's www.theocc.com in the market data section. These corporate actions are common in the marketplace in general, but for each investor, you will likely only deal with them on a very infrequent basis, so you might not be too familiar with what happens to the option. In the market data section, you'll find details such as changes in symbol, deliverable, possibly changes to the multiplier of a contract, or what exchange, or whether it's being delisted, or whether it's gone off the national stock exchanges. All details within the stock itself, the corporate action, and changes to the option contract will be outlined. You can research these memos by keyword if you're looking for a particular type of corporate action, ticker symbol, or by date range. If you are looking into this and you have questions, the OCC also provides a professional service. The investor services team will be able to help you identify and interpret these memos. You can send them email questions at options@theocc.com. That's the OCC information memos on the OCC website. Related to that, sticking with the theme of corporate actions, is a very good resource on the SEC's website. This is SEC's EDGAR system. EDGAR is an acronym. It stands for Electronic Data Gathering, Analysis, and Retrieval. First, the official description from the SEC website, quote, its primary purpose is to increase the efficiency and fairness of the securities market for the benefit of investors, corporations, and the economy by accelerating the receipt, acceptance, dissemination, and analysis of time-sensitive corporate information filed with the agency, end quote. Essentially, this is an electronic filing system used by the financial industry and investors to confirm or research details from forms which are submitted by companies to the SEC. For example, it might be helpful to know when an upcoming dividend is going to be paid, how much that dividend is going to be, or possibly a merger situation. What are shareholders going to receive? How many shares? Maybe they're getting cash. What's the effective date? There's all sorts of reasons why you might want to research SEC EDGAR. The forms can look a little bit complex, but they're fairly easy to read, and it's a very good resource. For a good read, I chose Introduction to Futures and Options by John Hull. This is a book that was originally published in 1991. It's very popular amongst educators for students who would prefer limited mathematics and more emphasis on conceptual learning. As you look at the outline, it starts with the more straightforward futures markets, and then it's followed by basic level options instruction, including an overview of price modeling, options on various products, not just equities, but indices, currencies, and futures. And there's also plenty of advanced concepts such as Greeks and volatility smiles. That's Introduction to Futures and Options by John Hull. That's today's tools, resources, and good reads.
We love connecting with our listeners. With that in mind, let's take a moment to answer a few questions on OIC's Wide World of Options Q&A segment.
I always look forward to our Industry Happenings section where we get to communicate with our listeners. I have a couple very good questions today. First from John S., who asks, by rolling a covered call, is a loss incurred? I get a lot of questions about rolling positions, and frequently the context is around avoiding or delaying a loss on a position. I don't really view it that way. Rolling is when an investor closes an open position, possibly at a loss, and then opens up a new position in effort to make that money back. This isn't really delaying or avoiding a loss at all, but rather establishing a new position with a slightly different risk profile. When you're doing this kind of position management, I always want to caution investors to make sure the resulting position is still consistent with your market outlook. Don't be too concerned with not wanting to take a loss. I completely understand the most difficult trade to make is closing out a losing position. No one wants to do it. Sometimes it is wise to adjust and keep the trade going. Sometimes it's best just to get out of a bad trade. But make sure you're honest with yourself, meaning you've made the adjustment because you still have confidence in your anticipated market move and you're not simply trying to avoid a losing trade. Even the most savvy and experienced investors have closed out losing trades only to see the market turn out in their favor. It's happened to me many times, and it's going to happen to you as well. Don't be afraid of that happening. Make the adjustments if you see fit, but make sure you're honest and it's consistent with your market outlook. John, thanks for the question. Also, Janet asks, for a dividend-paying stock, are short calls subject to early assignment on the ex-dividend date? Great question. I want to be very clear about how I answer this. First of all, equity options are always subject to early assignment. It's not uncommon, however, as Janet points out, for call holders to exercise in the money call options prior to the X date. think about this from the perspective of the call holder. They need to be a shareholder of record on the record date. If they exercise their call before the ex-dividend date, that transaction effectively occurred before the X date. They will then be a shareholder of record in time. So the call holder needs to exercise before the ex-dividend date. That's a direct answer to your question, Janet, but I also want to point out from the seller's perspective, you may not be aware that you've been assigned until early the next morning or possibly during the next trading day. So that's what I want to make clear. The holder has to exercise before the X date, but the writer of the option or the seller of the option who is assigned might not be made aware that they've been assigned until the next day. There's a multi-level process that has to be accomplished at the clearinghouse level and at the brokerage firm level to finalize, exercise, and assignment activity. It takes time, so it's very important for you to communicate with your brokerage firm and find out the timing of when they will let you know if you've been assigned. Great question, Janet. Thank you both for those very good questions. Keep them coming in, and hopefully we'll get some more questions next time.
You've been listening to the Options Industry Council's Wide World of Options. If you have any questions about anything you've heard on today's show, email Ed Modla at options@theocc.com or visit www.optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at Options Education. And follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.